Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about COREWEAVE Inc. Annual Report. COREWEAVE Inc. offers a wide range of businesses and services that cater to the needs of enterprises in the field of Gen AI. At its core, the company provides a cloud platform that enables scaling, support, and acceleration for generalized artificial intelligence, Gen AI, workloads. The company's product offerings include various infrastructure solutions such as GPU compute, CPU compute, storage services, networking services, managed services, virtual servers, and bare metal servers. These products are designed to support the complex compute workloads of enterprises. In addition to its infrastructure solutions, COREWEAVE also provides a range of services that cater to specific needs of Gen AI users. These services include VFX and rendering, AI model training, AI inference, mission control, and fleet lifecycle management. The company's platform also offers observability tools, node lifecycle controllers, tensorizers, and dataset optimization tools for machine learning developers. Overall, COREWEAVE Inc.'s comprehensive suite of products and services makes it an attractive option for enterprises looking to leverage the power of Gen AI in their operations. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to skyrocket. The stock price of COREWEAVE Inc. has seen a significant surge in the past year, leaving investors and analysts eager to understand the underlying reasons for this upward trend. Several factors could be contributing to this increase, although without specific information, it's challenging to pinpoint the exact causes. One possible explanation is the company's innovative products or services that have resonated with customers, leading to increased demand and revenue growth. This can create a positive feedback loop where higher sales and profits boost investor confidence, driving up the stock price. Another factor could be the company's strategic partnerships or collaborations with other industry leaders, which can expand its market reach and increase its competitive advantage. This can lead to improved financial performance and a more favorable outlook for investors. Additionally, changes in the overall market conditions or industry trends may also be contributing to the surge in COREWEAVE's stock price. For instance, if there is a growing demand for the company's products or services due to emerging technologies or shifting consumer preferences, this can drive up investor interest and push the stock price higher. In conclusion, while we cannot determine the exact reasons behind COREWEAVE's skyrocketing stock price without more information, it's likely that a combination of factors such as innovative products, strategic partnerships, and favorable market conditions are contributing to this trend. COREWEAVE Inc. market capitalization of $41 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that COREWEAVE Inc. holds a significant advantage in their industry. COREWEAVE Inc. trades at a higher price-to-book ratio of 12.06 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 102% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. Firstly, revenue recognition plays a crucial role, with committed contracts accounting for 98% of total revenue in 2025. This indicates that the company's ability to secure long-term contracts has been a significant contributor to its revenue growth. Another important factor is the cost structure, which includes substantial expenses in technology and infrastructure, sales and marketing, and general and administrative areas. The company's ability to manage these costs effectively will be critical in maintaining its revenue growth trajectory. Deferred revenue balances have also increased due to prepayments at contract inception, indicating that customers are committing to long-term contracts with the company. This trend is expected to continue, driving revenue growth in the future. In addition, geographic breakdown reveals significant revenue growth in the United States and other countries, suggesting that the company's expansion strategy is paying off. However, tax implications, such as net deferred tax liabilities and ownership changes under Section 382, may impact the company's financial performance in the long term. Overall, a combination of committed contracts, effective cost management, and geographic expansion has driven the company's revenue growth, while tax implications pose potential risks to its future performance. The net income of the company experienced a significant increase from 2023 to 2024, with losses decreasing by $594 million to $863 million. However, this trend reversed in 2025, where net loss increased by $304 million to $1,167 million. The net income margin also saw a slight decrease from -25.2% in 2023 to -22.7% in 2025. In terms of profit margins, the operating income loss showed an improvement from 2023 to 2024, increasing by $310 million from -$14 million to $324 million. This was reflected in a significant increase in operating income margin from -6.1% in 2023 to 16.9% in 2024. However, this trend reversed in 2025, where the operating income loss decreased by $370 million and the operating income margin dropped to -0.9%. The company's financial performance indicates a positive trend in its operating cash flow. According to the annual report, the year ended December 31, 2025, saw net cash provided by operating activities of $3,058 million. This significant amount confirms that the company is generating substantial positive operating cash flow. The consistency of this information across multiple pages of the report further reinforces its accuracy and reliability. As a result, it can be concluded that the company is indeed generating positive operating cash flow. The company's debt level has undergone significant changes over the years. Initially, it was reported on page 53 that the debt level had increased due to new debt issuances and amendments to existing facilities. This trend continued with a significant increase from $2.4 billion in 2024 to $6.7 billion current debt and $5.5 billion non-current debt, as mentioned on page 84. Furthermore, the total debt increased by 171% from $7.9 billion to $21.3 billion, with non-current debt increasing by 169%, as stated on page 123. The interest expenses have also seen a substantial increase. On page 70, it was reported that the interest expense had increased significantly from -$361 million in 2024 to -$1,229 million in 2025, with a change of plus 868%. This trend continued with an increase of $868 million, 240%, from 2024 to 2025, as mentioned on page 72. Additionally, the contractual interest expense increased by 157% from $475 million to $1,220 million, as stated on page 123. In summary, both the company's debt level and interest expenses have seen significant increases over the years. The debt level has more than doubled in some cases, while interest expenses have increased by hundreds of millions of dollars. Management is optimistic about the company's outlook, expecting rapid growth driven by increasing demand for cloud computing services. To support this growth, the company is investing heavily in infrastructure, including new data centers, and aims to capture more AI cloud spend from existing customers. In terms of financial strategy, management plans to increase investment in technology and infrastructure, while financing capital investments through a mix of debt and securities issuances. The company also holds strategic investments in equity securities of privately held entities to support its business objectives. Risk management is another key area of focus for the company, with measures taken to mitigate energy needs, interest rate risk, and foreign currency risk. However, material weaknesses have been identified in internal control over financial reporting, which management is working to remediate. Overall, the company's strategy prioritizes driving growth through investments in infrastructure and technology leadership, while managing risks and investing in strategic initiatives to support business objectives. The company has demonstrated its commitment to returning value to shareholders through various means. One of these methods is by paying out dividends, which indicates that the company has generated sufficient profits to distribute a portion of them to its investors. This practice not only rewards existing shareholders, but also signals confidence in the company's financial performance. In addition to dividend payments, the company has also engaged in share buybacks. By purchasing back its own shares, the company reduces the number of outstanding shares on the market, which can have a positive impact on earnings per share and overall stock price. This strategic move demonstrates the company's focus on maximizing shareholder value and its willingness to invest in itself through share repurchases. Supply chain disruptions, a growing concern. The extracted summaries reveal a plethora of concerns regarding potential supply chain disruptions. Multiple pages highlight the risks associated with various factors that could impact the smooth operation of supply chains. These include limited power supply contracts, inflation and volatility pressures in the global energy market, disruption in availability of significant components, and suppliers' inability to keep up with technological advancements. Furthermore, consolidation among suppliers may harm their ability to negotiate favorable terms, while labor and political unrest, geopolitical disputes, and natural disasters can disrupt supply chains. Suppliers may increase lead times or prices on short notice without guaranteeing capacity or payment terms, leading to potential delays in providing infrastructure and platforms to customers. The summaries also mention component shortages, supplier unavailability, and supply interruptions as possible risks. Securing alternate sources may be time-consuming, difficult, and costly, while data center providers' failures or disruptions could impact business operations. Changes in trade policies, excess capacity due to macroeconomic environment changes, and lack of availability and delays for data center equipment are also highlighted as potential concerns. In summary, the extracted summaries paint a picture of a complex and uncertain supply chain landscape, with multiple factors that could lead to disruptions. While there are no concerns about inventory buildup mentioned in any of the pages, the risks associated with supply chain disruptions are significant and warrant careful consideration. That concludes the financial summary for COREWEAVE Inc. Feel free to comment below, and I will be happy to answer them when possible.